Power isn't always visible. Money isn't always loud. On this channel, we break down the systems that quietly control the world. This is Silent Capital Opening. If markets crash tomorrow, it won't begin with fear. It won't begin with panic headlines. It won't even begin with falling stock prices. It will begin with something disappearing: liquidity. And when liquidity vanishes, even trillion-dollar institutions start to tremble. Because markets don't collapse when people are scared, they collapse when money stops moving. And most people never see it happening until it's too late. Tonight, we're breaking down the invisible force that silently controls every market in the world: liquidity. Section 1. What liquidity actually is. Liquidity sounds complicated, but the idea is simple. Liquidity is how easily you can buy or sell something without changing its price. If you can sell an asset instantly at a fair price, that market is liquid. If you try to sell and the price collapses because no one is buying, that market has lost liquidity. Think of it like oxygen. You don't notice oxygen when it's there, but the moment it disappears, everything panics. In financial markets, liquidity is oxygen. Stocks, bonds, real estate, crypto, every asset depends on it. When buyers and sellers are active, prices move smoothly. But when buyers disappear, prices don't decline. They fall through the floor, and that's when crashes begin. Section 2. Why liquidity is more important than fear. Most people think markets crash because investors panic. That's partially true. But panic alone doesn't crash a market. Illiquidity does. In 2008, banks didn't collapse just because people were afraid. They collapsed because mortgage-backed securities could not be sold. There were no buyers. In 2020, when COVID hit, markets didn't crash just because of uncertainty. They crashed because institutions rushed to sell everything at once. And when everyone sells, who is left to buy? Liquidity evaporates. Spreads widen, prices gap down, trading freezes. Fear may start the fire, but liquidity determines how far it spreads. Section 3. How liquidity disappears. Liquidity disappears in three main ways. First, leverage. When institutions borrow heavily, they are forced to sell assets if prices fall. That forced selling removes stability. Second, herd behavior. If large funds move in the same direction at once, market depth thins instantly. Third, confidence breakdown in credit markets. The bond market is the backbone of global finance. If banks stop trusting each other, short-term funding freezes. When funding freezes, liquidity vanishes. And when liquidity vanishes, prices don't fall gradually. They collapse violently. Because markets are not built on value alone. They're built on continuous flow. No flow, no stability. Section 4. The role of central banks. When liquidity disappears, who steps in? Central banks. The Federal Reserve, the ECB, the Bank of Japan. Their real power isn't setting interest rates, it's injecting liquidity. In 2008, the Federal Reserve didn't just lower rates, it flooded the system with money. In 2020, it injected trillions into markets in weeks. Why? Because without liquidity, even strong companies fail. Central banks understand something most retail investors don't. Markets are confidence machines, and liquidity maintains confidence. Without it, everything seizes. Section 5. Why retail investors miss this. Retail investors focus on earnings, news, charts, headlines. But professionals watch liquidity metrics, credit spreads, repo markets, bond yields, interbank lending. Because crashes rarely begin in stocks, they begin in funding markets. By the time stocks react, the liquidity damage is already done. That's why crashes feel sudden. They're not sudden, they're invisible, until they aren't. Conclusion: the invisible system. Liquidity is the hidden architecture of the financial world. It determines whether markets move smoothly or violently collapse. It determines whether institutions survive or disappear. And it determines whether panic becomes temporary or catastrophic. The next time you see headlines about a crash, don't just ask, "What are investors afraid of?" Ask a deeper question. Where did liquidity go? Because markets don't fall apart when people get nervous. They fall apart when money stops flowing. And when liquidity disappears, even giants start to shake.